myself become the villain. I can do those things because I'm not a hero. Not like that. I killed those people.
Welcome back to the channel, guys. We got a lot of stuff to get through, so we're just going to get right into it. SPY and the QQQ, as well as some major tickers within within both ETFs that we're going to get into. So obviously, in the past, we had this falling wedge, this giant channel, or this descending channel. We had a breakout out of it with moderate volume, decreasing volume when it's been consolidating, basically a contraction, which is what you want to see in a bull flag. However, we ended up breaking to the downside, negating that, and it was all based off a catalyst, which is the CPI data. And we're going to look into that first, just because it has to pertain with everything that's going on that we'll be talking about. So 8%, 8.6%, also 1% gain from April to May. And then also there's one other thing that I want to point out in this. Oh yeah, core CPI. Core CPI basically has peaked out in March. Currently, we're sitting at 6%. All right, but anyways, Thursday to Friday, we basically had like a 5.6% drop from Wednesday's close to Friday's close. It's actually pretty ridiculous, man. And how much we sold off. We're actually really oversold on the smaller time frames, which is why I got out of my positions. You know, I had waited for the CPI data to come out. I had played the chop within this range, but ultimately I didn't trade on Thursday. I was waiting for the CPI data came out really negative. I just went ahead and got in some UVXY shares and some SQQ shares, played the downside momentum. It worked out really good as a trade, but I went ahead and got out just once again because we are oversold in the smaller time frames. If we look at the 1 hour, RSI is majorly oversold, and we're still in oversold despite the little bear flag that we did have at the point in time. Monday and Tuesday, due to the uncertainty of what the Fomc might do, that's why I didn't continue to stay in my position. Just based off of technicals, though, just technicals, I would have expected there to be more downside. As you see in this consolidation period, we had a decreasing volume. However, the breakout, the downwards move, was on increasing volume, which is what you want to see whenever you see a confirmation of the move. RSI was in neutral territory. Now it's heading towards the oversold territory, but it's not quite there yet. So it gives you the idea there still might be fuel left to go. If we get out of this real quick and we go into the Bollinger Bands, there was a contraction whenever we were consolidating. Now they're expanding as the move progresses to the downside. We were overbought slightly, moved down to the second deviation by the close on Friday. At the open, we were at the first deviation. But again, once they start opening, you can see a continued move to the downside. And that's basically what I would be expecting. Standard deviation channel. Basically, we've been consolidating within this whole thing the whole time, either bouncing off the bottom to the middle, consolidating back down, top, middle, down, middle. Now it looks like we're about to hit the bottom of the range. Once again, we're in the middle between the zero deviation and the first and the second deviation. We're basically like at the first at this point, but I like keeping the second and third deviation on there. So I would like to see continued move to the downside. Last thing I want to look at, last indicator that I want to look at is the anchor VWAP deviations. The zero or the regular anchor VWAP is not present. I don't have it shown up, but I do have the -1 deviation, -2 deviation, -3 deviation, and -4 deviation. We've been cutting through them like nothing. So they acted as resistance, the first one. Ultimately, we broke through this little gap that we had talked about in previous videos that was acting as support during this consolidation period. Good move that we wanted to see. We got to the second deviation of the anchor VWAP, but we just cut through it like hot knife through butter, as well as that support level at around the 392-ish level. And basically, it's the same story in the QQ as well. If this wants to pull up. Basically, it was that falling wedge, breakout, consolidation period, broke through the gap on increasing volume throughout all this, just bearish sentiment throughout the whole thing. And the one thing that I feel like kept up the markets was Tesla, because of their stock split with the filing that we talked about, that we were going to talk about. Where's it at? Right here. They followed through the SEC, 3-for-1. I feel like that kept up the markets. One thing I wanted to mention, not that I told you so, because I don't want to sound arrogant, but in the last video, we talked about how there was a run-up for the stock split, but once it actually happens, expect a spike, but ultimately a sell-off. And that's eventually what did happen. There was hype for it, but thing happened, ultimately it died. So that's something to keep note of. But some major players as well, like Microsoft, they're back at the support levels that we were at before this trend reversal happened, as well as Apple. Same shit. We're at this 137-ish level. It's something to watch as if we see a break and a close with increasing volume below that line, it would definitely be something to watch. Something also we mentioned on Berkshire, as Apple is one of their main holdings, and head and shoulder pattern. I didn't say, I don't want to sound arrogant once again saying I had called this out, because honestly, anything could happen in the markets. There's no predicting what could happen. Fundamentally, I thought that there was going to be a bear market rally based off of those 7 red weeks that we had in a row. 8th week might have been like down here if we would have continued down, but ultimately we would have saw a shoot up just based off of like how oversold we were to create the right shoulder, ultimately possibly leading into the basically breakdown. And currently we're at the bottom. We're at this major support level. What is it, the 290-ish level? That have acted as resistance in the past. Once again, if we should break down to the downside, you can see the completion of this right shoulder, which would bring us down to about this 370-ish level, 375 level. Not looking good for Berkshire Hathaway. Not even Warren Buffett himself is buying his own stock. So that's something to keep note of. Some other stuff to keep note of. Damn, I'm skipping over everything. Bitcoin, as we mentioned previously, was in this bear flag, rising wedge, ultimately broke out. Not looking good for that either. Currently continuing to head down, and it looked like the pattern. It looked like the pattern was actually going to be bullish, depending on how you drew this pattern. I originally had it like this. I'm going to redraw. Give me a second, real quick. Where it was a falling wedge, breakout, retest, and ultimately had nice volume on this way up. But personally, I also wanted to keep in mind the bearish side of things, which was what I originally had drawn. This rising wedge, which ultimately did play out, we ended up breaking to the downside and we'll continue to sell off. So it's not looking good for cryptocurrencies either. And these would get hit more than the regular equity markets. And if the equity markets was to take off, again, these would be a laggard. Another thing to look at is basically commodities. I want to look at gold in specific, not silver. Gold had a nice move this week, if it does load. We had this breakout of this triangle, symmetrical triangle, wedge pattern, whatever you want to call it, breakout, retest, and currently heading to the upside. People have been mentioning this to me and the Discord I'm in. If the rest of the chart wants to pop up. Dang, my Wi-Fi sucks today. I basically had this cup, this handle, and currently we're experiencing a cup and handle within a cup and handle. This could be a very bullish setup, especially if we are heading into a time of fear and the tightening cycle that we're currently in. Another cup and potentially another handle forming. So a cup and handle within a cup and handle. That is definitely bullish. And honestly, this one took like a decade to form, so it wouldn't be surprising to see some crazy all-time highs to be created within the gold itself. DXY, we had this trend line that was drawn, ultimately a breakout, retest, cooled off a bit because it's been going up like crazy without nonstop, and ultimately now it's going to especially up considering the fact that we had that bad CPI data release. Another thing to look at is the put to call ratio. This is another reason why I kind of got out of my position, just because there was overly bearish sentiment in the markets just based off the put to call ratio. Doesn't mark bottoms or tops perfectly, as you can see here. There was a continued sell side to the downside, but just not again. I wanted to play safe, just consider the fact that FOMC meeting is going to be happening this week. Another thing to look at is the 2-year yield. Again, hitting all-time highs. People are uncertain of what's going to happen in the near future, and you can see that also reflected within the difference between the 10-year yield and the 2-year yield, which is often referred to as the yield curve. It has inverted earlier in the year, as well as it did in 2019 before the whole COVID crash. Not saying it predicted the COVID crash, but there was problems with the economy way before the COVID actually happened, which ultimately COVID was an excuse for the market to fall the way it fell. And we had a soft inversion previously. We want to see a harder inversion, which is a greater duration of time underneath this as it is inverted before ultimately flipping back to the upside. The gap between the two is getting slimmer and slimmer now. So will we fall underneath? Yes, maybe no. Who knows? Well, it's something to keep an eye on though. Another thing to keep note of is junk bonds versus TLT. People are getting less interested in corporate bonds versus treasury bonds in times of uncertainty, which is currently what we're going to be experiencing at the moment. We're having this boom. We technically did break out, but it looks like we're going to head right back under. It's just going to kind of be a wick in the longer time frames. Another thing to keep note of is the VIX with respect to the SPY, and when it's calling bottoms, usually in major bottoms, there'll be a capitulation type volume, which also incorporates wild spikes within the VIX. We usually get a reading of 40 and above at these major bottoms, which is currently what we have not experienced, which is people are arguing now that we'll potentially see even further downside considering the fact that VIX hasn't spiked yet. Another possible ticker to look at if you're looking to play the volatility of the market is the UVXY, which is the leverage ETF of the VIX. And if we were to get like a 40 move, like a move to the 40 level or even a little bit above that, we expect like a 20 level on this or a 25-ish level. And if you look back to COVID, which honestly it isn't really a good idea to compare just because how fast COVID happened compared to like what we would have and what we would go through. Basically, it was a crazy percent increase. Let me go ahead and zoom out real quick and let me go ahead and measure this move. And if you do that, basically you had almost a 1300% gain, which is fucking insane. But anyways, let's go ahead and move on to the next topic. Next topic is going to be United States Consumer Confidence Index. Basically, we're reaching record lows, which even beat the stagflation environment of the 1980s. And we're below the housing crash, below the European financial crisis, below the COVID lockdowns. We're at all-time lows, man. Another thing to look at is basically what are traders pricing at this point? Could it be a 75 basis rate hike at this next meeting? Could it be a 50 basis rate hike in September, 50 basis rate hikes for the rest of the year? What is the Fed going to do without pushing equity markets or even the economy in general into a recession? But they have to control inflation. So what are they going to do? Again, meeting's going to be June 15th. Time, when is it going to happen? It's going to happen 12 my time, which is Central Standard Time. So I think it's 1 Eastern Standard Time. Not only that, but you can also use this tool, the CME group, and look at their data, basically looking at the Fed meetings and what the traders are pricing in. And as you can see, there's spikes in what could possibly be priced in for the next couple of meetings. So it's definitely something to take note of, something to look at. It's pretty interesting data, and it changes. I think it updates every day or every couple of days. So it's something to look at, especially considering the fact the type of environment we're at the moment. Another thing to look at is the fear and greed index. This is why I don't like the fear and greed index, just considering how much bearish sentiment there is in the markets. It's still only at 28 when in comparison to other levels, we were all the way down to 7. That kind of frustrates me, and that's why I don't necessarily like to use this. But when it is at levels of extreme fear, that's whenever it'd be like good times to be able to get into the market. Whenever your plan is to hold longer, or even if it is in confluence with a lot of your indicators that you use. Again, Tesla has a 3-for-1 stock split that they follow with SEC. Gas prices hit a national average of $5, which is pretty insane. Another thing to look at is the 30-year mortgages hit 5.85%, which is insane as well, because a lot of U.S. homeowners who bought during COVID locked in a rate under 4%, which is insane to think that it's nearly almost 5x what they're paying, which turns into a lot of money if you know how interest rates work and compound interest works over time. Another thing I want to point out, this is a podcast that I like to listen to. It's from Moody's Analytics. Chief economist is Mark Zandi, and they basically go through different topics, and each basically podcast episode is something different, but it's something I'll watch for. But something that they mentioned that was actually really cool to listen to, it's kind of counterintuitive, is that basically the lower distribution of the wage curve, earnings curve, whatever you want to call it, their wages are basically outpacing inflation. So they're the ones who are beating it basically. It's the middle class that's suffering the most, and the highest class is kind of like tapering. They're not necessarily keeping up, but they're not necessarily suffering either. It's the middle class that's suffering the most out of everybody, which again is counterintuitive because you think that people with lower income class and lower income groups would suffer the most during inflation times. But I'm not saying it's not the case, but it's showing to be not necessarily the case when it comes to raw earnings. Another thing to keep in mind, what they mentioned was agricultural products. Basically, the U.S. has been, and really the world in general, has been doing bad when it comes to food production. For us, we have more drought situations, not as much of the harvest has gone through of what was supposed to have been harvested. And it's just a whole bunch of bad future projections. And basically, there's another article I had read that I don't have pulled up at the moment. Basically, costs of how much it costs in order to produce farm and agricultural products. Basically, farmers are really concerned about that, just because the cost of everything. Another thing to keep note of is so the way the vehicle prices and how they're accounted for within CPI data has changed. It changed last month. CPI data CPI data releases, and basically from here on out. But month over month, it has increased, and what economists thought was that it was going to peak out, as it has been rolling over for the past couple months. Used vehicles, that is, not new vehicles. But that's not the case anymore. We ended up not peaking after all, and we're actually increasing pretty damn fast. Supply constraints were easing up. China COVID restrictions were kind of easing up. Everything was looking good, but CPI data is looking bad. EU sanctions, as well as the Russia-Ukraine situation, is still looking bad, and it's just putting a whole bunch of pressure on the economy at the moment. So guys, that's basically included this video. It's a lot to unpack, but basically good luck in this week of trading, and hopefully you made it to the end of the video. Follow me on Instagram for more frequent updates and more quick information and some funny ass memes. But in the meantime, good night y'all, and best of luck for this upcoming week.